If you work in public sector accounting or are just curious about how governments manage massive budgets, this is a topic you can't afford to ignore. Ipsas 5 is the secret behind smarter government accounting. It's a powerful tool that ensures transparency and consistency in how borrowing costs are treated, making financial statements more reliable for everyone, from auditors to taxpayers. Here's what you need to know. Whether you're a student, a professional, or just someone interested in public finance, understanding Ipsas 5 can give you a real edge. Ipsas 5 is all about borrowing costs. Think interest on loans, fees you pay when borrowing money, and other costs directly related to financing. These aren't just numbers on a page, they can have a huge impact on how much a government project really costs. But here's the key. Ipsas 5 tells you exactly when to expense these costs and when to add them to the cost of an asset. This distinction is crucial for accurate reporting and for understanding the true value of government investments. For example, if the government borrows to build a school, the interest paid during construction isn't just a regular expense. Instead, it's added to the cost of the school itself, making sure the financial statements reflect the full investment in that asset. This approach helps show the real cost of building public infrastructure. But what if the government borrows money just to cover day-to-day expenses, like paying salaries or utility bills? In that case, the interest is treated as a regular expense and goes straight to the books. It's not added to any asset because it doesn't directly relate to creating something of lasting value. So, Ipsas 5 helps make financial reports more accurate and helps users understand the real cost of public projects. It's about clarity, accountability, and making sure that everyone, from government officials to the public, can see where the money is really going. Simple, right? But it's also incredibly important. Getting this right means better decisions, more trust, and stronger public finances. Remember, apply Ipsas 5 only when borrowing costs relate directly to a qualifying asset, like a building, a road under construction, or any major project that takes time to complete. These are called qualifying assets, and they're the heart of this standard. Otherwise, if the borrowing costs don't relate to a qualifying asset, just expense them as they come. This keeps your financial statements clean and compliant. Mastering Ipsas 5 isn't just about following rules. It's about understanding the logic behind them. When you know why these distinctions matter, you can spot errors, advise your team, and contribute to better financial management in the public sector. Want to really nail this topic? Dive deeper, ask questions, and keep learning. The more you know, the more valuable you become in your field. Hit like, subscribe to Accounting Desk, and check out our detailed Ipsas 5 video in the Ipsas playlist.